Michael Burry is accusing hyperscalers of artificially inflating EPS by modifying the way that these companies depreciate their assets by using longer than fair values. I will be honest, I think Burry has an agenda, and everything that he's putting right now is going to be bearish because he already has a put on Nvidia and on Palantir, which I think is crazy by looking at this chart. Speaking of this chart, the vertical lines represent each time Burry has been bearish on the economy. The first one in recent times, 2019. Back then, he was quite bearish on index funds due to the increase in passive retail investors, and he specifically said the longer it goes on, the worse the crash will be. Well, if I go back to the charts, back then, between the moment he said that to the peak, there was a 15% run in the S&P 500. And by the way, the reason we had a sell-off, it was not because of a crash in index funds. It was because of an exogenous effect, the coronavirus. So maybe he could have claimed during the pandemic, yeah, I was right. You see, I called it. But call me crazy, this was not the reason why the stock was down, the index was down, is not because of a crash due to retail investors piling into index funds. Moving on, we have in June 2021, he literally said this will be the mother of all crashes, all hype, speculation. Is drawing in retail before the mother of all crashes. He said that when crypto will fall from trillions, or meme stocks will fall from tens of billions, the Main Street losses will approach the size of countries. History ain't changed. Let's look at history. He said that, right? Markets rallied about 15%. And when eventually the crash came, which was, you probably know, the Fed ramping the interest rates at the fastest pace in history, the crash was 27%. Far away from what he said the mother of all crashes, because if you go back to the 2000s, the dot-com bubble, that was 50%, all right? And I'm looking at the S&P 500. And the 2008, 2009 was 53%. So the mother of all crashes, I'm expecting anything, a sell-off higher than 50, 55%. 27% is not enough. Moving on, we have August 2022. Back then, Burry was saying, and yet I keep getting asked when crash, right? He was still bearish, which makes sense because the markets were selling off. What happened after that? The markets found the bottom and they went up. Then we have, in January 2023, this was big. He pretty much used social media to say sell, right? After that, I think it's clear what happened. There was a pullback, the markets rallied, and I think it was in a couple of months later, he went back on Twitter, and it's quite sad to see this message. He said, going back to the 1920s, there has been no by the freaking dip generation like you. Congratulations. This seems to me very, a very hostile message, and it conveys a lot of frustration. There is a frustration, I believe, because he's quantitative. He's looking at P ratios, valuation. That's why he's investing in China. He's not keen on the US, apparently. So I see a lot of frustration there. And this message from back then, I recognize that back then I didn't read these messages. I mean, I'm not following Burry. He seems to be in the headlines because over the last week and a half, some people attribute the sell-off to him. Others, like me, I believe it's just noise. People taking profits after quite a significant run. And this message makes me believe that, there is a lot of hostility and he's not really, I don't know. I feel like he's more bullish on China than the US. And that's where I digress with his view. And then, of course, we have August 2023, where he bought puts on the triple Q, and then another put, and we're talking about 739 million of notional value. And then there was another one, 886 million notional value. That was a put on the S&P 500. And if you look at what happened after that, small pullback, the markets rallied. Burry is not the genius that Hollywood wants you to believe. He's smart. Don't get me wrong. He's doing his analysis. He's a guy that I always feel like he's an analyst more than an investor. And 2008 he was spot on. I didn't invest back then. I didn't have an age to invest back then. But certainly, I don't see a catalyst for his thesis to materialize. What is going to lead to this to pop? What's the catalyst? Is because if you look at what the Fed is doing, the Fed is lowering interest rates. So if you look at the CME group at the projections for December this year, right, there is only a 32% chance of the interest rate to remain in the same level, 375 to 400, and 67% chance of this rate going down. In addition to this, which, as you probably know, when the Fed lowers the rates, this adds liquidity in the market, which is very bullish for equities. Aside from this, we have the Senate that recently passed a measure to end the government shutdown. The package now went to the House, and it seems that Trump is going to support it, which means that the shutdown is going to end, which is great news because Powell said back in the last meeting that the Fed was driving through the fog. So if the Fed is driving through the fog and they don't have the data, people were quite skeptic whether there's going to be another rate cut in September. If we have the data now, it's very likely he's going to lower the rates, especially if unemployment is going to show, I wouldn't say alarming, but 4.3, it will be 4.2, 4.3 is the base case for me. And I would assume 4.4, 4.5%, it wouldn't be a surprise if it increases to that level. And, then we have the fund managers, 72%. This is an argument I really like that Tom Lee is doing. And he's saying that most fund managers, I think his values were 80% over the past 3 years because that's how the funds are rated based on their performance over the past 3 years. It seems that they are underperforming the index. And let me be clear. Underperforming the S&P 500 in the current bull run it's difficult. You really have to be invested into boomer style dividend stocks to not be able to perform the S&P 500 when almost any equity that is exposed to AI is blowing up. Is this a momentum run? I believe there is a combination of momentum. Yes, mostly momentum. I agree with any bear in the market. This is a momentum run. However, this is backed by fundamentals, and this is backed by macro because you have tailwinds from the Fed. You have unemployment, which is going down, which is only going to add more fuel to the fire for the Feds to lower the rates, which usually ends up in the market. That liquidity, ends up in the market. So overall, I don't think it's a stretch to assume that this is going to hit new all-time highs before the end of the year. And I'm sorry to say, but Burry, at this point, I can see he has an agenda. He has puts. I believe those are probably covered, so he probably has sold another put he probably has a spread. But that's just a speculation. You probably know that in the 13Fs you don't have to declare the positions where you're short, meaning that a put is not exactly a short because you're buying it. So if you sell a put, that's a short, and you don't have to disclose it. Probably he's doing a spread. In any case, he's not. I would say he's not neutral. He's not objective in his thesis. And I'm wondering, what is the catalyst that he believes is going to lead to the decline? Because that's when when I ask the bears in the market, I'm saying, I always ask, what's the catalyst? What do you think is going to make the stocks to re-rate at fair value? And they don't have a clear answer. They just say, yeah, over valuations. Yeah, over valuations. If you look at NVIDIA was overvalued since, 2000, overvalued. If you look at certain metrics, price to TTM cash flow, price to sales, it was always expensive. And by the way, NVIDIA is not expensive if you were to compare it with the players in the dot-com bubble. NVIDIA is trading, I think, at 29 times next year earnings. That's less than Walmart, So call me crazy, but I think NVIDIA is more valued than Walmart. Yeah, betting against NVIDIA and Palantir is crazy, to be honest. In any case, I respect that. It's a bullish call. It's a bold call, is what I wanted to say. And let's see where this goes forward. My bet is that the markets are going to continue due to some of the tailwinds by the end of the shutdown, the liquidity in the markets, and the fund managers that are underperforming. Likely, they're going to double down in the market, maybe in Q4, trying to recover some of those losses and hopefully getting closer to the S&P. All right, that's my opinion. Let me know your thoughts in the comments. And see you next one.